Welcome to Markets Now. I'm Michelle Rook with Alan Brugler, Brugler Marketing, and it was a down day in just about everything but live cattle futures. And Alan, let's talk about the grain complex. It did feel like a risk-off day, but soybeans really kind of led the charge down. So were we taking out weather premium, or what was going on in that market today?
Well, I think it was mostly uncertainty. Okay, you're not sure what USDA is going to say about the crop condition ratings. You're not sure what they're going to say about industrials. This is sitting there Monday during the trading session, and so you did not see a lot of money coming in off the sidelines. The asset allocators were selling last week, Thursday, Friday, particularly taking money off the table that they'd made earlier in the month. You didn't really see that coming back into the market. On the bean side, I think the other thing was on the soybean oil. You had what I thought was pretty good news from the biodiesel and renewable diesel report for March, which came out late on Friday. That report showed increased biodiesel and renewable diesel production. It showed increased use of soybean oil in that production. Those should have been positive inputs. But what you saw in bean oil was at midday on Monday, you were down 144 points. So that lack of product value flowed over into the beans. And obviously, drought is not an issue for corn or beans right now. It's more of a concern of can we get the last 15-20% of those crops planted and get suitable moisture levels after the crop is up.
What about the corn market? Did it just follow soybeans, or again, were we taking out weather premium there with the ideas that rain makes grain, that crop condition ratings this afternoon would be pretty decent?
I think a lot of it was anticipation that we would get very high crop condition ratings, given that we have very, very little percentage of the crop that's in a drought area. This year that's been declining for weeks here. 3 months ago, the talk was Iowa's extremely dry and no subsoil moisture, and that talk has totally gone away now. I still think there's a long-term bullish component there in the corn and in the beans, particularly if we get this El Nino to La Nina transition that the forecasters are talking about. If we get that heat up in July and then maybe get some pocket droughts of some kind going in August, that might be enough to boost the market. But for right now, you're sitting here saying, hey, rain makes grain. We're getting rain just about everywhere across the Corn Belt. Planting progress is really keeping up to the average pace across the Corn Belt. There are areas of concern, and I have sympathy if you're in one of those, but the market works on the big picture here. So, yeah, I think we're taking weather premium out and saying, show me, convince me we've got a problem. The other beneficial aspect, if you will, of this price break, and I try and find the sunny lining here. We have about a month left for export sales to be good for corn, old crop, before the Brazilian second crop hits the market. And we had priced ourselves out of the market with that rally in late April and early May. So this price break should start to drive some more export business over the next couple of weeks. Inspections would not have shown that this morning because those sales were made weeks ago, but we should start to see some improvement in export sales. And we did get a little of that business to Spain this morning.
Technically, let's talk about corn and soybeans. How much damage have we done? We did have lower weekly closes last week, but today's close wasn't good either, was it?
No, we've got a head and shoulders top on some of the corn charts. I was encouraged July futures were able to hold the 2/3 speed line support, but of course they broke the moving averages. The December corn as well kind of suggests a retest of the April low or God forbid the February low. The best thing I can say is that we are oversold already, and we did try and hold that support. So the other thing is, and I think this got overlooked, on a monthly chart, monthly continuation chart, this was a third higher monthly close in a row for corn. July was down on the month versus July, but versus the May, which is what we were tracking at the beginning of the month, we actually had about a nickel gain for the month of May. So it's not as bad big picture wise as perhaps the daily charts look.
We did have a reversal in the wheat market again today, and looked like we got pulled down by corn and soybeans going lower. But is the weather rally over there? Is this market tired or what?
I think the wheat market's tired. You've of course, people have tried to top pick it 3 or 4 times and gotten burned each time. Wheat earns its reputation of trade wheat, sleep in the street. But our technical models, our price and probability forecasts in particular, look at the average price movement in wheat over the last 40 some years. And given where we were back in February and March, we've reached the most likely highs for the period. In other words, the price variance has been larger than statistically expected for this time period. So to me, that tells me that the quant funds are going to start to back off here in terms of putting new money in. And if they feel that the momentum's out, then they're gonna back out of those positions. Weather-wise, yeah, you got a little weather forecast, a little wetter weather forecast for Russia that'll allow some replant or at least planting of other crops if they don't want to go wheat at this point. But the market has pared back its wheat expectations just a little bit.
Yeah. Cotton market got beat up, limit down move. Was that economic concerns, and how much more downside risk do you think there is?
Well, I mean, there's I can give you all kinds of different technical targets there. I think the economics is the question. You were getting some fairly buoyant economic signals that were suggesting that the Fed could not cut rates in June and might have to raise rates in June. Then you saw the GDP downward revision late last week. Stock market actually rallied pretty good on Friday, but you gave a lot of that back today.
Also, we're getting this crop off to a much better start than we did a year ago. Is that playing into this?
Yeah, I think that's a big part of the picture. The ending stocks forecast for cotton aren't all that bad. I mean, they're fairly snug, but we are looking at some increase in cotton acres, and you're looking at excellent planting progress to date and excellent condition ratings, we think. The other concern, of course, is what's global demand, which gets back to that economic discussion. Are we in fact slowing down here a little bit? There's been storms. No question that some of the severe weather is not good for any of our row crops. But you have to remember that statistically, those are fairly small areas of the overall crop. It hurts if that rain or that hail or that flooding hits you, but it's rarely a big percentage of the U.S. crop.
So we saw a little bounce in live cattle today. Did we just kind of hold some support that we needed to, and can we build on it?
Yeah, we bounced off some moving average support. We've got the bottom line is June futures are going to go where the cash market wants to go here. Cash did back off a little bit last week, $1 to $2, depending if you're looking north, south, or wherever. But the board can't break much if the cash doesn't. And we are in a period of tighter ready numbers compared to some other recent years. The Packers got a bit a little harder to find cattle if he's got a home for the beef, he or she. We did bounce off, as I said, off pretty good moving average support there in the cattle. The big picture story on cattle is still where we are in the cattle cycle. Are we holding back heifers? Pasture condition ratings have been pretty good in all but 2 of the states that we track. That would suggest that there's incentive, if you will, to hold a few heifers back. Certainly, cow slaughter has slowed down quite a bit. It's the slowest since 2014, which was the last turn in the cattle cycle. So where am I going with that? It's supportive to feeders, because if you pull out the heifers, you're going to have even fewer feeders.
All right. Thanks for joining us. As always, Ellen Brugler with Brugler Marketing. That is Markets Now.